All right, let's get right into it. In the huge and, let's be honest, pretty murky world of private credit, there's a risky financial tool that's making a major comeback. Now, this is a practice that can either be a total lifeline for a growing company or a massive warning sign of deep financial trouble. So what are we talking about? We're talking about PIK loans.
And you know, this quote from A Invest just hits the nail on the head. It's a double-edged sword. On one side, you have this innovative tool that helps lenders win deals and lets borrowers manage their cash flow. But on the other, it could be hiding some really serious problems just beneath the surface of the entire financial system. So you see, understanding both sides of this blade is absolutely critical.
So first things first, let's make sure we're all on the same page. What in the world is a PIK loan? Honestly, the subtitle here is probably the best way to think about it. It's basically the buy now, pay later for big corporations. Okay, so the way it works is actually pretty simple, but the consequences, well, they can get complicated fast. Instead of paying their interest bill with actual cash, a company with a PIK option can just say, hey, just add it to my tab. So let's say you have a $100 million loan with 10% interest. You don't need to find $10 million in cash. Nope. Instead, your loan principal just balloons to $110 million. The debt literally starts compounding on itself, getting bigger and bigger and bigger.
This brings up a pretty obvious question, right? If the debt just keeps piling up, why is this whole thing booming right now? Well, to get the allure, you gotta look at the bigger picture of what's been going on in corporate lending.
So over the last few years, the traditional loan market, where big banks bundle up loans and sell them off, it hit a really rough patch. It got pretty unstable, and that created this huge void. And who stepped into that void? You guessed it, private credit. They started providing the financing when the old guard just couldn't, or maybe wouldn't.
And look, we are not talking about some small niche corner of the market. The private credit space has absolutely exploded. We're talking over $1.7 trillion. It's become a total powerhouse in finance, and PI loans, well, they're one of the key tools these lenders are using to get a leg up on the competition.
So let's break down who really wins here, okay? For the companies borrowing the money, it's all about cash. It's about liquidity. They get to keep their cash to pour back into the business instead of just paying off debt. For the lenders, it's a way to offer a sweeter deal to win the business, and they get to charge higher interest rates for that flexibility. And for the private equity firms that own a lot of these companies, it's the ultimate get-out-of-jail-free card for managing their investment.
But this is where the story takes a sharp turn. Because while PK can be a super useful tool, its growing popularity is also being called a canary in the coal mine. You know, that early warning sign of some serious hidden dangers.
Yeah, research from the Northern Finance Association shows this really clear pattern. When interest rates go up, PIK usage goes right up with them. And why is that? Well, it's because higher rates make those cash interest payments way more expensive, and that puts a huge squeeze on companies. So they start turning to PIK not for strategic growth, but because they have to.
And this right here perfectly explains the two faces of PIKE. You've got what we can call good PIKE, which is planned from day one. It's part of a company's growth strategy. But then you have bad PIKE. This is when a company is already in trouble and they have to change their loan agreement simply because they're running out of cash to pay their bills. And that is the one that has analysts really, really worried.
And we're not talking about a small problem here. The data shows that a huge chunk, in some cases more than half, of all new PIK usage is falling into that bad PIKs camp. So this isn't just a few struggling companies here and there. It's a widespread trend. And it's telling us that there's some serious stress building up in the market.
I mean, the academic evidence on this is pretty damning. That same study found that using PIKE is a powerful predictor of bad things on the horizon. Companies that use it are way more likely to miss payments down the road and eventually even file for bankruptcy. It's a massive statistical red flag.
All of this leads to a really dangerous situation called shadow defaults. See, a company might look fine on paper. It's technically current on its loan because it's paying with more debt. But in reality, it's a financial zombie, just kept alive by more and more debt. Some folks watching the market think this hidden default rate is sitting around 6%, which is way higher than any of the official numbers will tell. So what's the bottom line here? Is PIK some brilliant financial innovation that's changing the game? Or is it the seed of the next big crisis? Let's break down what investors should really be watching for as this all plays out.
And this is really the multi-trillion-dollar question, isn't it? In a market that's always chasing high returns, that line between a smart, innovative move and a totally reckless gamble can get blurry, fast. So how do you tell the two apart? Well, analysts suggest you focus on three key things. First, keep an eye on PIK exposure.
If a fund is getting more than, say, 10% of its income from this non-cash interest, that could be a sign of trouble ahead. Second, you've got to look at the loan covenants, the actual rules of the deal. Are they strong enough to protect lenders, or are they super loose and just encouraging risky behavior? And finally, and this is the most important one, it all comes back to telling the difference between the two types of PIK. Is it the strategic good PIK, or is it the distress signal bad PIK? The answer to that question tells you just about everything you need to know.
This is not financial advice.